Okay, good morning, good afternoon, good evening, depending where you are in the world. Hi, everybody. So today's webinar is all about buying and selling at extremes. Can you guys hear me? And thanks. So per usual, I like interaction. So ask any questions that come up as they come up. Don't hesitate to throw those out there, and I'll do my best to pick them up as we go along. We're going to do a lot of sort of real-time chart analysis today, and we're going to talk about the periphery sort of fundamentals of things and that kind of thing. All right. So I hate to use the war analogy, but I just cannot come up with a better one. All right. And obviously we all trade differently, so I can only really talk about how I do business, and then maybe that translates to something that you do. I don't know. All right. But I always think about trading as for starters, what I'm just sort of thinking as I'm talking out, I find it difficult psychologically and honestly results drivenly to try and trade every single thing that moves. I think I find it difficult. I find it unsustainable. I find it unproductive, and I'm much better off. By the way, there's all kinds of noise about a grease deal, hence why you're seeing a lot of weird price action going on. So my point being is that for myself, I prefer to make trading as a part-time job, and when I mean that, not in terms of financial, but a part-time job in terms of how I approach things and how much time I'm actually legitimately spending pulling the trigger. Okay. So my point being is this: it's a long-winded way to say that I like to pick my spots. All right. And sometimes I will have very few things going. And then other times I'll have a lot of things going. Okay. And my results will show that I make most of my money for the month in a couple of days, or said differently, my position executed for the month typically within a couple of days here and there. All right. And then, things do what they do, and win, lose, or indifferent, it all happens within a confined period of time. The other thing to consider here is that I'm not selling you anything, so I'm trying to give you information that actually really works in your life. All right. So my war analogy is as follows. If you are, and those of you that have listened to me a fair amount have heard this before, but humor me, please. If you are a sniper on a hill, and this is you over here, now bear in mind, typically it's you and two other people, or you and one other person, a spotter, and maybe a rear security guard. It's only between 1 and 3 of you over here. And sometimes you can see all sorts of different things, all right? But because of the weapon system that you carry, this is what you can hit. Okay, anything in here is fair game. But just understand something, that the cavalry is not coming for you in about 20 minutes at least. So sometimes, however, you can see things here setting up kind of, and you can see things here. All right. But you cannot hit those. You could maybe, if you lob something out there, possibly. But what's going to happen majority of the time is that you're going to stir up the hornet's nest, and you're going to be on the run here because these guys are all going to come and get you. However, this stuff here in the blue, you can and you better you hit it because you don't want this is that this area in the blue is the extremes of the market. In other words, those where those can pull to market visits. Those of you that have read that or listened to that, it's very specific. All right, and then these guys out here, yes, we can see stuff, but sometimes we hit it, sometimes we don't. But I'll give you an example, okay? And the one that comes to mind is the pound. I had an order at 58.50, okay? Both of them missed that target. Okay, so I'm not in this pound short. All right, now it came down and touched the support absolutely beautifully. You can see there's nothing wrong with this buying opportunity here. But because that is not an extreme of where I think there's going to be buying and selling, in other words, if this is the scope of the move, this buy here would be buying at 70% of the done move. And that's not great English. My mom would have a fit. But that's not 70% of the prescribed move, or it is 70% of the prescribed move. So therefore, I am more interested in shorts because it's at that range, despite this being a good short. Now, why is that poor? Well, because it's in the context of what is still arguably a downtrend. And you can see what's going on here. Not such a hot buying spot. Hence why I had, 1,000K ready to short. Okay, so my point now is, well, now I think that we're heading, towards here. Sort of 150 to 149 level. Got a bunch of buys waiting here. Because at the end of the day, I think this is still a range. And it's just a matter of how you define the range now. I think it's largely this to sort of this with a in-between part that's, right around the sort of 150 area, 150.50. So to me, this would be, sort of buy here, sell here, kind of thing. If that makes sense. The other thing to think about too is this. All right, so let's talk about what is an extreme in the market. All right, an extreme is kind of one of those things that is an enigma to define. All right, but it is when the market is the most stretched out it can be, or the most retraced it can be. So what are the signs of this? Okay, there are a couple of them. Let's talk about those. Try to get a fresh piece of paper here. Okay, number one is, how do we know when we're at an extreme? And what I mean by an extreme is, and I've said it, I'll just define it in 1 second, it's when the market is the most overbought within the context of a downtrend, or frankly, the most overbought within the context of an uptrend, and the most oversold in a downtrend, or the most retraced in the context. It's it's when it's done with 90 to 95 or 100% of that move. Okay, so how do we know this? And why is that the best time to trade, in my opinion? Well, because you have the maximum amount of exposure in the other direction when you have to assume the smallest amount of risk, and you potentially at turning points of the market where you can ride stuff for a long time, and it's easier to do. Okay, so how are these levels defined, or how do we know when we're approaching this sort of zone? One, I like it around 150.50, and then I've got orders sort of all the way down into the 49s. And I'm going to help Jen. I'm going to try and define that as I go along. So give me 10 minutes, and well, 150 pips is, I mean, that's not necessarily a drawdown. Yeah. And that's why I talked about last week, having a large enough account size that you can trade a decent size and absorb some things that it doesn't bother you, and you can still trade around a little bit. Jen, if you don't mind, I haven't forgotten your question, and I will come back to that, and hopefully it all kind of falls into place. Fair enough? Cool. So, right, how do you know when you're at an extreme in the market? Right, number one is max optimism and pessimism. So what does that look like? That looks like gold in, 2010, 2011. There was no ways gold could go down. Gold was, when the stock market dropped, people bought gold because it was the safe haven trade. When the stock market went up, people bought gold because it was the inflation trade. Oh, look, it's the anti-inflation hedge. Gold's going up. Oh, look, the stock market's dropping. Buy gold. Safe haven. There was analysts left and right on TV telling you it's going to $9,573,000 an ounce. Right? Max optimism, ridiculous, preposterous, everybody on board with the optimism is a very good sign that you're approaching an extreme. It's my favorite sign. And max pessimism is even better. Right? And I believe that the euro is heading pretty close to max pessimism here shortly. Oh, Greece is going to cripple the eurozone. Draghi left it way too late. QE, no, their banks must be hiding skeletons. There's no ways they're going to create any kind of inflation. There's Europe's going to collapse. They're going to break up. This is a divisible union. Sure, it probably is. We'll cover that in just a sec. My point being is that yeah, I don't particularly fancy extremes on the 15. I mean, I'm more inclined just to stick with extremes more on the dailies and things. But we'll talk about those too. So max pessimism and max optimism. And guys, do not get caught up in the news cycle of these things. Do not get caught up in their opinion. I cannot stress that enough. If you turn on the television and all you see is bulls, you understand that it's probably time that things are going to go the other way. Okay? Right, number two is the the way that news cycles through. Okay, I'm going to address all your questions. I promise you I'm not going to miss them yet. All right. When an uptrend is in place, okay, when an uptrend is in place, it starts off, or in the middle of it, it's they buy on good news, okay, and buy on bad news. Okay, this is the middle of an uptrend. The strongest part of an uptrend is when there's a slew of bad news coming out and there's just relentless buying. All right. When you know that this cycle is sort of transitioning is when you start to see them buy on good news and sell on bad news. In other words, they're selling on merit. Whatever that, you know what I mean? I've never really subscribed to this because good news can be bad news. You know, CPI and home starts are great. Our housing was great last week. Yellen said the economy is good, so everybody's like, okay, well, now we're going to sell the stock market. Nah, let's do for it. All right, but these are things you can watch. Okay, and inevitably, this creates volatility, this phase. In other words, you're not directional, but you're very volatile. Something reminds you of this phase, maybe. There is definitely something in the market that is squeaking about that. I can think of two things. Stock market, and to me, the likes of silver. Right, number 3. What is an extreme? Or how do you know? What are the signs? Okay, obviously, big daily, weekly support and resistance. It's that simple. You look on the chart, you can see, hey, we are way out there, man. Okay, and we'll touch, you know, this one we're going to look at. Number 4. Distance. I'm doing massive abbreviations here, but it'll be recorded. Right, distance from EMAs. Oops. Or SMAs, whatever you want. Okay. So in other words, if you are historically stretched out from where you have been over the last 20 years of trading, the patterns repeat. Chances are there's going to be some semblance of a mean reversion. And the one that comes to mind right now is the USD yen. We'll look at that. Number 2 is about the news cycle. Sort of, you know, when you're in a good uptrend, they buy on bad news, no problem. And then they sort of buy on good news and buy on bad news. And then you cycle into buying on good news, selling on bad news. And then you will start to cycle around to good news is ignored and only bad news is sold. And then the trend has changed, but you're probably too late at this point when they selling on good news, selling on bad news. So it's good to be aware of where you are in that cycle. And Friday, we started to see a little bit of selling good news. It's something to keep in mind, or rather Monday. Okay. So there are other things, but these to me are your major weapons in play here. And obviously there's pivots and there's fibs and okay. But the major one of these is the opinion driver. If there is just relentless, overwhelming opinion, do you think you would go down more, or is it on the reverse? I'm going to have a look at that. I actually had an order today to long at 108.50, so I'm only up a handful of pips on that. So I'm going to have a look at that, and I think it's going to go down a little bit further, but we'll take a peek. Right. So let's talk about these a little bit. Let's start with, okay, my point here is this, before we get to the charts. My point here is this. If you look at something and the scope of the move is this much, even on an intraday basis, guys, don't be longing it here. You bottom feeding. Don't be shorting it here. You're bottom feeding. Okay, even if you're buying and selling on a 15-minute basis, trust me on this. You're doing yourself a disservice up here, because if you're a little bit wrong, you're going to get absolutely smashed, and then you're going to miss the other side of it. Okay, so let me pick a good candidate for that. How about this guy here? Right, here's the USD yen. This is a monthly chart. All right, notice where we're at. Okay, also, yes, there's a hard top here. There's a hard top here at this 124 level. All right, but notice that there's sort of soft breaks here and wicks into themselves here. And they just happen to be right around sort of 25 and above. Okay, notice where this 21 EMA is. Yes, it's a monthly chart, but we're building a case. All right, so my point is this, going to the weekly chart. Let's say, yeah, let me switch to an hourly very quickly. Let's say that it tops out here, comes right back to sort of 122.80, and there's, in technical terms, there's nothing wrong with that buy. You know, that's probably a long. But here's the scope of your move. This. Probably. Right, that's probably it. So you would be buying basically when 70% or more of the move is done. Okay? Could the USD yen be going to 130 on interest rates going? Yep, probably. Sure. But what's more likely? We go back to this weekly. Actually, this monthly, because it really tells a story. What's more likely? That price is going to nudge above here and come all the way back down here, or it's just going to go, or it's just going to do this. I would argue that the blue scenario here is way more likely than this green scenario. Yes, it is free to do it after that. It's free to do sort of something like this. No, yes, okay, stop. Reassume the trend. Sure. And then everything's caught up in all these EMAs that do sort of something like this. You've seen that before. However, what I'm trying to say is the likelihood of trading long here, it just doesn't seem that, it just seems like bottom picking to me. Where this is, you know, potentially 300 pips, this here is more like 2,000 pips. Right? In extreme. And if you look at, you know, if you look at something like this, okay, this is sort of a gimmicky way to look at sort of EMAs stretched. Okay, but here is a monthly, what I call envelope, and basically what this is it's EMAs from 5 to 100 spread by 5 or 10. So 5, 10, 15, 20, blah, blah, blah. And it just shows a really good way of trend analysis. Okay, but look at where this 5 EMA is. And then you look at periods where it's stretched above that historically. Yeah, it did it here. Okay, I always like to look at the bull side and not the bearish side, because the bearish side can stretch out more than the bullish side. Fear is a brilliant driver to stretch something out. So you want to look more at the bullish side. So this is telling us that these two are saying it can stretch out a little more. But notice that it doesn't necessarily go, it keeps a consistent stretched outness. So our thesis of 125 and change to 127 looks pretty good. And then bring it back, this will sort of catch up to the envelope, then bring it back here. It's 2,000 pips. And then you can make the case of, okay, well, no problem. Right? And now you guys are sitting there going, well, he's a counter trend trader. Yep. Pretty much. Okay. And, but can you see what I'm getting at? Said differently, I would have a hard time buying it here, even on an intraday basis in this zone, because I know that's hot red. That's like extreme red there. All right, and my point today is more just to be aware of where you are in the context of the grander market. So how would one execute on something like that? I don't know. Here's a 4-hour chart. I would probably do this. I would have a red zone in mind. My red zone is here, basically. I would expect price to do something like this. And this is what I'm talking about, is that I have no problem waiting, because I know that this trade from here, to here is maybe more. That trade there is a month's worth of money. And if my job is to wait and I get paid to wait, fine with that. Absolutely fine with it. Can work on 17 other things. All right. So how would I expect this to look? I'd look, something like this. And I'd expect, one of those continuation patterns right around the resistance. And then, hello. Oh, no thanks. Orders. Short, short, short. I think it could, I think realistically all the way to like 117, 114. It's going to take a long time, but yeah. And I think once again, because the Fed's going to disappoint. The Fed might raise a quarter basis point or 25, but more than that, really? Right. So let's talk about, but can you, okay, the point is this. The point is this. There's a few things in play. One is the fundamentals. We just talked about sort of Fed stuff there for a second. Number two is the resistance on the larger time frame. That's a terrible looking D. Resistance on, the longer term time frame, and then you can boil it all down to the shorter term stuff. Number three is the distance, the mean reversion sort of distance back to things. Okay, and then obviously the news cycle in this context doesn't necessarily play a role. But this is the way the case is built. It's called a trade plan. And honestly, if it blasted through 126 and went to 128, it would feel uncomfortable, but I wouldn't necessarily worry. Why? Because I've waited for an extreme. And the speed by way of it gets there is also important as to how far and how much it's going to stretch out. And frankly, it would just mean more opportunities. All right, so let's look at another one. Show you this. And I'm going to answer your questions on pound and euro here in just a second. Yeah, here's silver. Okay. There is a pretty good looking little trend line here. Right? There is also serious sort of range support here. Okay? And it's arguably made a continuation flag on this monthly chart. So let me go to the weekly. Notice also it is range bound and volatile, but not going anywhere. Right. I really believe that this is a scenario that we do this. Hello. Oh. Okay. It is a continuation flag without a meaningful retracement into support. This looks like a buy here. For about $10. And that is, in effect, 100% return on that trade. You know, after that, who knows? But can you see how that would be an extreme? You know, something like this. Okay. And realistically, that would only probably be about a 15% retracement on the drop. But said differently, I don't feel so hot about any intraday or meaningful short anywhere in the zone. Why? Because I know that the scope of the move is probably this. And I would be shorting basically 70% of the move done. 80% of it. And that to me is bottom picking. I'm sorry, bottom feeding. There's a difference between bottom picking and bottom feeding. Does this make sense? I hope it's resonating. I hope people are sitting there going, well, I may not be into this strategy of trying to, buy the stuff, but I see what he's talking about in terms of taking my intraday trades right around where there's a major hammer blow coming. Maybe that in itself is the secondary epiphany to this. Right. So let's talk about this euro. Sure. The problem is this. Again, I can, like I said to you, I can only tell you, I can only relate to you how my trading, I can only relate to you how I think as a human being and as a trader, and then try to relay that. And then maybe you take some of that and work it into yours. Okay, I like a trend too. My problem, there is definitely a difference. So, said differently, if you were selling the Aussie at 73, I think you'd be bottom feeding. As opposed to bottom picking. Right? Because to me, 70 to 74 is, happy zone for Aussie. So selling it in there, even on an intraday basis, to me is bottom feeding. You're going to have to be very cheeky about that. And I'm just too old for it. Just too Too jaded for that stuff. All right. What's got you confused? What's got you confused? Sandy, it boils down to this. Okay, let's go to the Aussie real quick. All right. Here's the Aussie dollar. And I want to talk about trends and why they're difficult. Here's the Aussie dollar. Notice this. Notice this. Okay, notice the distance here. Is the Aussie dollar, or rather, is the Aussie economy the strongest it can be? Probably not. Have the Australians got it together? 100%. They're the leaders in renewable energy. They're the leaders in sustainable farming. They're getting on board with the tech world. They're funneling money into China. They have a ton of commodity wealth coming up. The Australians have it together. Yes, they have a little bit of a housing sort of bubble in a few areas, Melbourne particularly, Adelaide, but they have it together. Is the Australian economy going to wilt and collapse under itself? No. Okay, so there might be some serious pessimism down here. What I'm saying is it's probably not going to die. We'll have a look at that too. All right, so for me, this is the extreme on the Aussie for at least something back to this. Well, that's 1,000 pips. Okay, so if this is the scope of the entire move before a meaningful retracement, selling it through here to me is bottom feeding. Because I know that this thing is going to boomerang around, Aussie reference. You know, to me it's 70 to 72.50, 70 to 73.50 is all fair game. Or something like that. I am very bullish in the early 70s. Yes, that is exactly what I'm suggesting. So this is what I'm talking about in terms of just I don't like to sell even on an intraday basis right where I know that things are probably going to want to turn around. You know, and there's probably a fantastic short that does this. Thanks. I just don't feel hot about that one. It's one of my little rules. And two, I don't like to buy and sell after a major support or resistance. And I know, you know, I don't want to tell you stuff that's going to get you in trouble, but I'm really sort of trying to actually give you more instruction as to how to identify stuff that's going to get you in trouble. Yeah, we'll get there. We've got 7 minutes. Let me do Euro very quickly because it's effectively the reciprocal, and then we'll have a look at the S&Ps. You know, the pound, sorry, I'm jumping around. I just don't want to miss any questions. You know, the pound to me is this trade. Something like that. So this 50, you know, we'll even call it 49 and change to, I don't know, 160. That kind of thing. This is an extreme, that's an extreme. I do not. Okay. Let's go look at those Euro and S&Ps very quickly, and dollar index if we have time. We might run out. We got 6 minutes. Okay, Euro. Downtrend still in play here. I think it's worth mentioning that in terms of its logical sort of Fibonacci extension, the 102 area is that. In other words, this relationship, this 50% to 1382 sort of extension, is your normal scope of a move for a big move slash currency. Same thing, but you know what I mean. So I think it's reasonable. I think it's reasonable that we do sort of something like this. We'll push down, back up towards sort of 117, 118, and then it ranges largely for months and months and months and months. Okay, I'm even almost expecting it to do this even. Kind of revisit 116, then push down towards 102 and make about a 1500 pip retracement. Okay, you know, something like that. So, and this is going to be max pessimism. Understand, if it, and I'm anticipating this drop here, so from like 116 or so all the way down to like 102. Understand the news cycle. Boy, apocalypse, total apocalypse. Euro getting destroyed, just, it's going to be blood and guts on the streets. That's what you want. They're going to be talking about dividing the Eurozone. I mean, just many things. Okay, that's what you kind of want to see. And then I think, I don't know about parity. I mean, I'm going to start buying around 102. Okay, my point being, though, is that in 3 years' time, or 2 years' time, the euro is going to look very cheap around 102. Very. Yeah? Very cheap. The Aussie is going to look awfully cheap around 70 cents in 24 months' time. Because I think just a lot of that, a lot of the shine is going to come off the dollar. Things are going to flatten out. The U.S. economy is pretty good, though. I mean, I was driving through Hilton Head the other day, and it's pretty impressive, actually, what they're building and what they're doing. No, I'm just saying that in 24 months, 102 is going to look cheap on the euro. Because honestly, I anticipate something along these lines where we go down there, spreads around, up towards a sort of 118, then it ranges, threatens to break lower again, and ultimately we head towards 125, 2017. So I guess what I'm saying is, to me, this parity to 102 zone is a pretty good chance of that being the low for, 5 years. It could drop lower than 149, that's fine. But I think that if you look at where the pound, look at how much pound bounced, and you've got to remember too that I've got to end up here soon. I want to touch on the S&Ps. Remember that the world goes in this cycle: US, GBP, Eurozone. Don't forget this. We've talked about this in other things. And then Asia does this. Okay. Things, the dollar strengthens, the pound will follow, the euro will follow, then the Asia, and then, things will cycle around like this. You might get a little bit of movement in between, but that is the typical part of it. And you look at pound made a move from 146 to 158. Euro went from 106 to 14. A disproportionately smaller move. So I think that the pound will drop disproportionately, or the pound will drop less because it's showing better relative strength. So even a lower low out of the euro will probably not see a lower low out of the pound. Point being. Okay. And honestly, this S&P has surprised me a little bit. I was really hoping to see, a nice little continuation down here towards 2092. And we're not. So it's got me concerned. But it's the same sort of thing. I consider this whole area extreme here. Looking for this. This is a continuation sort of. It's my 2 cents there, and we're kind of out of time. Guys, if you have any questions on my Twitter, it's probably one of the better ways to get a hold of me at Forex David. That's Forex David. And I hope you learned something. Today is probably an uncomfortable lesson because you're getting told something that you probably shouldn't get told with regards to a lot of what other people are teaching you. But if maybe go watch it again, I'm trying to actually articulate something that's going to keep you out of trouble rather than get you into trouble. If you treat it incorrectly and you're impatient, you're going to be in max trouble. Max trouble. Yes. Max trouble. So patience is key here. All right? And I hope you learned something, and we'll catch up with you guys next month. Thank you very much.